All right, boom. We are live for our Tuesday Phoenix RIA Red Room. Today we're here with Luke, as always, and Devin, also known as Mr. Burr. You can watch us on the Phoenix RIA, or we're also on Luke's Facebook channel, our Facebook, just Facebook page, and then my YouTube channel and the Viking Brothers YouTube channel. So
that's right.
So just had lunch with Devin, and we're gonna just got a little history from him. He started out as a wholesaler, but now he's got a different strategy of financing. I've obviously been in hard money for a long time. I've just obviously seen his stuff on social media. I was like, I gotta dive in a little bit deeper than I'm getting just on the reels and stuff. So
heck yeah,
here we are.
I love it.
Well, guys, thanks for having me. It was we just got done eating Mexican food, and I was just saying before we went live, like I am a little lethargic, but I'm gonna try to keep the energy as high as possible. So
where'd you guys go?
You guys had me on. We went to Blanco.
Okay, there we go. Blanco's good.
Biltmore. My wife was highly jealous when I said that I went to Blanco. It's like one of her favorite spots. She was like, "And you didn't bring me back some?" So, I'm in the doghouse a little bit right now.
Right. Heck yeah, I get that a lot. Same thing. I just might go out to eat, and I don't bring food back to the wifey. You definitely get that.
100%.
All right, well, let's just jump in.
Heck yeah.
We had lunch, and I found out that you started wholesaling. How'd that journey start, and where'd you start there at?
Yeah, so I learned about wholesaling New Year's of 2019. So December 31st, 2018, January 1st, 2019, whatever you want to call it.
Right.
And I wanted to start getting into rentals, and one of my buddies, he's like, "Dude, why would you do rentals? Do this thing called wholesaling." And I'm like, "What in the world is wholesaling?" And he's like, basically just move paper. So you assign the contract. We all know what that is, from A to B. And I'm like, that sounds really interesting. So I kind of went on my YouTube University kick. I just was literally trying to learn everything I could from YouTube. So I read books. I watched YouTube from January 1st until like September of 2019. And I felt like I knew a lot, but I didn't do anything. I just was kind of paralyzed by fear. And I'm a very visual guy. So if I see somebody do it, I feel like I can just emulate what they do. Prime example, right. I learned how to snowboard by going to a mountain and just watching how people snowboard. I'm like, okay, so that looks easy. So then I did it from just seeing it. So I had a buddy in the industry, Templeton Walker. We go back since 2011. I knew he was doing flips and wholesaling and all this. So I'm like, dude, how much do I got to pay you to just ride along for one day, see what you do, and that way I can try to do it as well? And he's like, you don't got to pay me anything. You're my homie. So did a ride along with him. I saw him belly to belly with a seller, locked up a contract in 20 minutes, made 15 grand. I was like, this is incredible. I can do that. So started trying to find deals, went on Facebook groups, went on just social media, just different things. Found my first deal 2 weeks later. It was in Chicago. And I sent it to Temp, and I thought I was going to make $200,000. So I got my job the next day. Legitimately.
Oh, that's awesome.
I circled the date on my calendar. It was October 8th of 19. I walked in and I quit, and then just fell flat on my face from there. I didn't make any money for probably 4 or 5 months.
Did you make any money on that deal though in Chicago?
Yeah, I didn't make what I thought I was going to make.
Okay.
I thought I was going to make about 200 grand, but the property was in a little pocket in Chicago where you probably need a bulletproof vest. It was bad. So I just didn't know. And I didn't know that you needed a lawyer in Chicago and Illinois. So a lot of learning experiences. I think I made about 18,000, but it took 4 months, and just learned a ton, man, and just never looked back.
Heck yeah. And then, so how did you transfer your wholesaling? Did you get into flipping, or did you go straight from wholesaling to just buying rentals?
Yeah, so I was doing wholesaling and then started taking down some flips, and I realized that it just sucks. Like flipping properties just sucks. You get kicked in the face left and
Yep.
right. You never make what you thought you were gonna make. There's always surprises. You pay more than you thought you're gonna pay. It takes 4 or 5 months, 6, 7 months sometimes.
Mm-hmm.
And then what I realized is like I got away from corporate America because I knew that I was paying a lot of taxes. Like the more you earn it with earned income, the more you pay in taxes, right? So with flips, you pay a lot of taxes because of capital gains. So I'm like, how can I get away from taxes? How can I just build more wealth? And my last name is Burr, Burr.
Yeah.
So I'm thinking, well, my last name's Burr. There's this Burr method. How about I just coin myself as Mr. Burr? Because I am Mr. Burr.
Yeah. Yeah.
So
That's awesome. That's super cool. Because I had no idea that your actual last name was Burr. So, I mean, that's very fitting.
yeah, we made a music video. Like I thought of that idea, and me and Temp made a spoof music video to a Chingy song from back in like the early 2000s. It's Right There. So
Yeah,
then we made that to like getting Burrs, and basically just everything I've done is with zero marketing. It's just kind of being creative on social media and different platforms to get organic growth.
Yeah.
And I've never paid for marketing. So I see a lot of these guys doing so many deals, and it's like, it's cool, but how much did you spend to get all those deals? Like, I'd rather just do a few, have less headaches, and just keep all of it because I'm not spending to get them.
Yeah, for sure. No, it makes
All
total
right,
sense.
so let's dive a little deeper into your as most of you know, I'm a hard money lender, and we talked about it at lunch. I just lend at 12%. I borrow it at 10% from, I got like 20 buddies that lend me money, and they did better than me. So, but Devin has a unique strategy that's a little different, so you can kind of double dip. So why don't you explain that?
Yeah, so what I do, guys, is I started doing the Burr method, right? And I started holding on to properties, realizing that I could build actual wealth and, get a slow drip instead of just transactional money. And then I started thinking like, well, how can I make it even better? And I heard a podcast of somebody talking about how to become the bank. Like the ultimate in real estate is being the bank because you have total control. You don't have much risk because you're collateralizing the asset, right? So how can I become the bank on my own deals? And I found a way to do it by just putting my money into a place that gets guaranteed compound growth. And when I say guaranteed, I mean guaranteed. It'll never stop earning money. The growth rate is 3.25. So I put all my money towards this place, 3.25 growth, guaranteed, like clockwork. And then what I do is I borrow against that money. So I'm borrowing somebody else's money. My money is the collateral. Then I just take the money, their money, go lend it out to someone else or go do a real estate deal. And then I keep the difference. So I keep the arbitrage, the spread. And the more I do that, the more money I make, the more I can put towards that guaranteed growth, that guaranteed interest. So it's really just using OPM and using my money as the collateral.
So you bring in investors that you've spoken with, and what do you typically end up paying them on a monthly basis?
Well, that's the thing. It's a little different. So Chris does it a little different than I do. What I'm using is, I hate to even say it because the second I say it, the blinders go on. They think it's a scam, and all it is, guys, it's properly structured whole life insurance.
Okay.
And why would I use whole life insurance? Well, whole life insurance companies are the most stable companies in the nation. The companies I use have been in business for over 140 years. These companies have been profitable every single year through the Great Depression, World War I, World War II, meltdown of '08, COVID. These companies are profitable. Think about all the biggest buildings in the nation. Who's at the top? Insurance companies. So I put my money into that vehicle because it's guaranteed to grow. It's stable. They're not going anywhere. It's protected against lawsuits and judgments. So all my money, if someone tries to sue me, they can't get to it. It's privately held in that contract. I don't have to report it to the government. It's a private contract. There's no taxes. And at some point, I'm going to die, unfortunately. It happens to all of us. So when that happens, my wife gets a multiple of my cash. So whatever I have in there, she gets the death benefit instead, which is always a multiple of whatever my cash value is. So that's what I'm using, is just properly structured whole life insurance, using that as a storage facility for my capital, and then just borrowing against it for whatever I want with no questions asked.
Wow. Crazy. That's crazy.
Explain how, like, so, you know, you're getting that 3.5, which is tax free, right? So basically kind of like, you know, if you basically call it 5, and then when you borrow against it, when you pull it out to maybe, let's say you do like a hard money loan, like I would do, what's your charge to borrow against it?
Great question. So when you borrow against the insurance policy, what you're doing is you're borrowing from your future death benefit. So you never have to pay that loan back. You could literally never pay it back. And when you pass away, if you didn't pay it back, it just lowers the death benefit.
Right.
So that's it. So you're borrowing from the future death benefit. They do charge you an interest rate, and it's generally 1% higher than your guarantee. So the guarantee is 3.25. You borrow at like 4.25. So,
Okay.
but here's the thing. If I'm earning 3.25 that's compounding, but I'm paying back a simple interest loan, I will actually earn more than what I pay, right? Because simple interest, your balance is going down, amount of interest is going down. Compound interest, amount of interest is going up. So what I do, I borrow against the policy. Let's say I lend it to you, Chris, on a deal you're going to pay me 12%. I take that 12% you're paying me and I just pay it back towards the loan.
Yeah.
What that does, that makes my death benefit whole again, and it makes the interest that I owe the insurance company less because I'm paying down the balance.
Right.
So my spread gets bigger and bigger and bigger the more I just flow the money back through the policy.
Wow. And then if you're, you know, remotely active in real estate investing, as you are, obviously you have multiple opportunities and strategies to where you can easily make more than 3.5% interest. I mean, realistically,
Correct.
you know, if you're doing hard money like Chris, or if you're, you know, gap funding, or if you're, you know, whatever, doing flips or putting that money towards wholesaling, whatever it ends up being, you know, odds are is you're going to be able to make a lot more than 3.5%. So I get that.
Correct. And even if you don't, like if you don't make more than 3.5%, again, if you pay simple interest back, you're going to earn more in compound interest. So you can literally just borrow the money for anything you're going to buy in general.
Yeah.
I've bought cars. I've paid for the wine cellar in our house. Think about this. When we either do one of two things with money. We spend our own. So we buy things in cash, or we borrow from a bank or borrow from a lender. So we're either going to pay them interest to borrow their money, or we're going to use our money and we're going to give up the interest it could have earned, right?
For sure.
It's called opportunity cost. So what I do is I put my money in the policy first. That way it never stops earning money. I borrow against it. Let's say I go buy a car. I just bought a Audi R8. Bought that thing with cash from my policy. If I would have bought it from the dealership, I'd have to pay them interest, right? I'd have to pay them payments every month. So I just treat my money just like theirs. Whatever they were going to charge me, I pay that back to my policy with interest. So I'm just keeping the money I would have normally given up to someone else just by flowing it through my policy.
Right. Crazy. Chris, you ever heard of anyone doing anything like that with life insurance?
I have. I've someone's talked to me about it, but I never even got the breakdown of how it flowed.
Right.
I have a question. Like, if I go buy a deal in my 401k, it's tax free. Is any gain in that whole life insurance policy tax free? Let's just say you bought a house and flipped it in that policy. Is that something you could do and get no tax on it?
Unfortunately not, but I guess with a 401k, the difference is I think you're limited on how much you can use, right? It's like, and you're talking about like a self-directed, right?
Yeah, I have a self-directed, so
Yeah.
I lend money on it, and I also do little flips in it because let's just say I just do like a hotel with it, like, and I can make 30 grand, and the 30, maybe I do it for 300, I make 30, the 330 goes back in tax free, right? So
Which is, it's a great strategy. The only issue, or not issue, but I guess limitation would be is like that 30 grand, you can't just use it for whatever you want. It has to be towards retirement, right?
yeah,
So if I go make 30 grand with a deal and I had the short-term insurance policy, I can use that 30 grand for whatever I want. I don't got to put it back in the policy. Because again, if I don't pay it back, the insurance company guarantees two things. They guarantee that they're going to pay a death benefit when I pass, and they guarantee 3.25% growth on the money I put in. So they're going to pay a death benefit at some point. If I don't pay them back, they're just going to lower the amount.
Right.
That's
Wow.
the difference, is you have more flexibility. If I make 30, 40, 50 grand outside of my policy, I can use it for whatever I want, which what I do, this is kind of crazy, is I borrow against my policy to go make more money. And then when I make more money, I don't necessarily put it back in the policy because, again, I don't have to. I take that money and start another policy. So I get even more money compounding and growing tax-free. And I borrow against that, rinse and repeat, go do it again. I've got 9 policies at this point. I've got my 10th and 11th in underwriting right now.
Now, there's a limit to how much you can stick in a policy, or once you start the policy, that one's done, you got to start a new one?
Yeah, there's limits. So you basically decide that limit at the beginning. So let's say you wanted to start a policy, Chris, and you're like, you know what, I'm going to put 100 grand a year into this policy. You can't put more than 100 grand a year. You've set your limit. If you put in more, it becomes taxable. So that's when you start more policies. When you have more money to put in, you don't put it in that one until the next year. You just start another one beforehand.
Okay.
And then, so once you have 100 grand in that policy, then you can pull that 100 at any time that you want. You just have to make sure you put it back in. And if you don't put it back in, then it just comes back against your life insurance at the end when you die.
Correct. Think of it like equity in a house, right? If you have 500 grand in equity in a house, equity being your cash value in a policy.
Yeah.
If you use all 500 grand of your equity, you don't have any more to use until you have access to your growth. So if your house appreciates and you get your equity line raised, same kind of thing. You don't have access to your growth until the end of the year. So unless you put money back in the policy, you don't have anything else you can use until you have access to your growth. Right.
Interesting. Wow. And then how does that draw, how does the draw process work in the sense of, is there a lot of paperwork? If they say, hey, okay, you say I want to take out 50,000 and put it towards something, do they say, okay, what are you putting it towards? Or is it pretty just you take it whenever you want?
Whenever you want money from an insurance policy, you can get it, no questions asked. So you just go online. I've got dashboards in place, which every company can set you up with one, or you can just call them.
Yeah.
But there's I take that back. There's a couple questions they ask. One being, is this for a divorce? Are you in this? There's a couple states where you have to disclose which state you're in, but they never say, what are you using it for? They never pull your credit. They never have you send them financials. If you have cash value, if you have equity, you can use it for whatever you want.
Cool. Super cool.
So how long have you been doing this?
So guys, I learned about this strategy. It's called infinite banking. I learned about it during the pandemic. So I was getting all my real estate deals by going to local meetups and just talking to people, making relationships, and then doing JV deals. That all went away. Like pandemic squashed all that. There was no meetups.
Yeah.
So I was just like, how can I learn something? I heard the podcast, and I got my first policy May of 2020. And it was a small policy because I wanted to see if it was real. I mean, whenever someone thinks about whole life insurance, they think it's a scam. They think it's the worst place to put money because it's going to take forever to have any cash value, which is true if it's not designed correctly. So I started a small policy of $6,000. 3 days later, I had 5,000 of it that I lent to someone at 15% interest. So they're giving me like $300 a month, but my 6,000 still compounding. So I'm like, this is nuts. Let me start a big policy and use it for my real estate. So I started using it for real estate, and I was blown away. So I just was telling everyone, mom, dad, aunts and uncles, brothers and sisters. And I was in a mastermind December of 2020, and Ricky Morgan, I'm not sure if you guys know who Ricky is.
Yeah.
Good buddy of mine. He's like, dude, why don't you get on TikTok and start talking about how you're doing real estate and infinite banking? I'm like, TikTok? Like, the only thing I thought about TikTok at the time was my daughter doing her little.
Yeah, for sure.
You know, like, I'm like, I'm not going to get on TikTok and dance around. Like, what are you talking about? And he's like, no, you can get on there, just make informational videos, grow a following, and then maybe you can somehow monetize it, get more deals coming in, whatever.
Yeah.
So I was like, all right, cool. So my third video on TikTok, it's me sitting in my car, and I'm talking about how to get all the money back for all the cars that you buy by using this concept. And I go to bed, wake up the next morning, 17,000 followers like that. And I was like, I think I might be onto something. So I just kept making more videos, and I got up to like 150,000 followers in about 2 weeks.
On TikTok?
On TikTok.
Oh, wow.
And I had everyone asking me like, this is incredible. Where do I get a policy? How do I do this? So what I was doing is I was just like, yeah, go to this guy, Chris Noggle. That's who I was getting my policies from. Go to him. I was sending like 15, 20, 30 people a day.
Damn.
And dude, it hit me one day. I'm sitting in my backyard. I'm about to like call him and give him like 20 leads. And I was like, wait a minute. They're learning this from me. Shouldn't I be the one that sets it up?
Yeah.
So I asked Chris, I'm like, how can I benefit from this? And he's like, just get licensed and you can set the policies up. So I've been licensed since March of 2021. And I've set up close to 1,400 policies in that time frame. Just all from social media.
Oh, wow.
Crazy.
So I'm sure everybody on this podcast knows how to go get licensed to be a real estate agent, right? You take your 90 hours. How do you get licensed to do what you're doing? Just because I've never asked and I don't know.
There's a website that I use. It's called AD Banker. So AlexDavidBanker.com. And it's just a self-paced study. You can get like flashcards and a book, and you just study for it. And as soon as you feel like you're ready to take the test, you go to a local testing facility. You got to get a 75%. I am horrible at taking tests. I barely passed high school. Like I passed with a D average, and I actually got held back in the second grade even. Like, how do you get held back in the second grade? Like, I couldn't use the scissors. Like, I'm not the sharpest guy. I actually didn't pass the test the first time. I got a 74, so I missed it by one question. And then I had to retake it, and then I passed it by one question. I got a 76.
There we go.
Yeah, that's it. You just got to pay to take the test. It's like $30-$40, and then you have your license, and then you got to hang your license, just like with real estate. You got to hang it with a broker. So I hung my license with the same agency that wrote my first policy. So now I'm on that team, and I just write policies for them.
Nice.
That's awesome.
So they don't have like an hour requirement like the real estate guys. It's like you just memorize it, or you study enough to pass a test and you're good.
Yep, you study enough and then you hurry up and forget everything you learned, because you don't need to know any of it for what we do. We don't sell life insurance. We teach a concept of how to control money. Yeah. And you just happen to need that kind of life insurance policy to do it. So then we set it up.
Melissa asked, what do you charge to do that?
This is the crazy part. Zero. I don't charge a penny. My team doesn't charge a penny. We are paid once you fund your policy. The insurance company pays us for bringing in business.
Super cool.
And question number 2, how much time does it take to set it up?
It depends. I mean, you got to go through a health exam. You have to.
Oh, wow.
I mean,
I guess that makes sense. Yeah.
It's life insurance, right?
Yeah.
Yeah.
Like if you've got a $10 million death benefit, the
Yeah.
insurance company wants to make sure you're not going to die. And
Yeah, right.
Yeah.
So you got to go through a health exam. They're going to look into your background, your driving record, your criminal record. They're going to do some digging the bigger the death benefit is. So my experience, it takes about 6 to 8 weeks from start to finish. But then once it's finished, then it's just about moving the money. You don't want to just put it there and let it sit. You want to immediately borrow against it and go put it in a real estate deal. You want to immediately borrow against it and put it in some stocks that you feel are going to go up. You want to take it and put it into your business. You want to take it and pay debts off. You want to use the money right away. You just always want it flowing back to the policy. And that's how it gets good.
Makes sense.
Cool. Anybody
that's
have
awesome.
any other questions? Well, we got Devin on here.
All right, Devin. So do you mainly, is most of your income come from that then, from your life insurance, or does it come from burning properties?
Most of my
Your
you
income.
said? So I've got different streams. I mean, what I've learned, I was an employee 3.5 years ago, right? And that was one stream of income, very limited. I've now learned like the more streams of income you can have, the wealthier you can become. So
Absolutely.
my life insurance policies, me setting those up is one stream of income. I have affiliate income. So if I talk to someone and they need help with their taxes,
For
I have
sure.
an affiliate to send them there. If they need a business so they can flow things through their business, I have an affiliate to send them there to set that up. We've got Airbnb properties, so that's what I do when I do the BRRRR method, is just on Airbnb. All those are here in Phoenix. And I don't flip properties more. I don't wholesale anymore.
Yeah.
Absolutely hate it. So I don't do that. But the other thing I do as far as income goes is just private lending. So I'll lend from my policies and I just have those checks in the mail coming. That's the best income. You don't got to do anything. It's the most passive income in my opinion.
Do you run your Airbnbs?
I do. I have a software called Guesty for Host, and it does most of it. So it'll send a lot of just different messages when there's a booking, when someone's checking out. But one-off questions, I'll just answer them.
For sure.
I don't want to give up 25 to 30% of
No, we do this. We do the same. So trust me, I get it.
Yeah, it's a lot. 25 to 30% is a lot for how your Airbnbs do this winter. I know there was inventory was up, but how did you do?
They did well. There was a couple months where we lost a little bit of money, but we're talking a couple $100, nothing crazy.
Yeah.
But for the most part, they're averaging per property, I'd say throughout the year, if you annualize them, we're probably at about $1,500 to $2,000 a month per property.
Heck yeah.
Yeah.
That's awesome. Did they take any hits or were they pretty booked out for the Super Bowl?
Oh yeah, all booked out.
Awesome.
We crushed it. We crushed it this last month.
Good to hear. That's great. Because we heard Chris and I were just talking about that. So we were hearing some mixed reviews from the whole Super Bowl. You know, I mean, there was actually a decent amount even in Scottsdale, which is kind of crazy, but Maricopa County in general, that were not booked out. And I mean, obviously there's so much more competition, you know, this past year. And we were saying, I think that a lot of people were just buying them literally for the Super Bowl and just, you know, hoping to make a killing for the Super Bowl and then looking to sell them again. So that's why I was curious to see how yours did.
I'm a realist. Like, I don't get real greedy. Like basically we had a software in place. It's Price Labs.
Yeah.
And it said on one of our properties, we were going to be able to pull like 3,200 a night for the Super Bowl. And I'm like, that'd be dope if we get that. So I had it at that until about I think whenever the last game was that
Yeah,
decided
yeah.
who was in the Super Bowl,
For sure.
it,
Gives you
it
2
was
weeks.
it was like 2 weeks
Yeah,
out.
yeah.
And then I gave it a couple of days. It didn't book at that. I'm like, all right, let's jack the price down. I think a lot of people were just like greedy.
Yeah.
And they were like, I'm going to get 2,000, 2,500, 4,000 a night. I ended up doing about 1,600, 1,700 a night for the property. So really good.
Yeah, for sure. And what is that
if
property?
I would have kept it out there and like, let's say if it would have booked for 3,600, 4,000, that would have been awesome. But if it didn't book, I'd rather get 1,600 a night than 0 a night.
No doubt about it. And what does that property get on a nightly basis otherwise?
Most of them are usually hovering around 400 or 500 a night.
Yeah, that's crazy. That's awesome. So yeah, so it was about 3x what it normally is.
Yeah.
We got another question. How do you lessen your capital gains? That doesn't really that vehicle doesn't really stop you from paying the taxes on the money you make, though, right?
So I'm glad someone asked that, because traditionally no, but I have a structure set up, and this was set up by my tax attorney, and it's utilizing properly structured trusts and a private family foundation. So all of my money goes into this structure tax-free. So I literally don't pay taxes. Let's say I purchase a property and it's owned by my business trust. If I sell that property, there's no capital gains because the trust owned it. So as long as I keep those gains within the corpus of the trust, the body, I don't got to pay capital gains. If I take those out, I got to pay capital gains. But what I do is I just keep everything in the corpus of the trust. That means that, let's say I go make $1 million, no capital gains. I just take that million to go make more. It comes back in tax-free. Corpus of the trust gets bigger, and it all just has to be set up properly. So I've got that set up as of last year. I set it up, and it saved me $305,000 on my tax bill.
Oh wow!
Yeah, that's pretty hefty there. That's awesome.
Well, cool. We appreciate you jumping on. We do this every Tuesday. If you're watching, like and follow us on our if you're on our YouTube channels. But thanks for jumping on with us, Devin.
Heck yeah, we appreciate it.
Explaining this all to us. I've heard about this, but I just didn't know the kind of the nuts and bolts of it.
Yeah, Chris, you need to be doing it, man. As much money as you lend out, all you'd be changing is one thing, just where the money goes first. You put it in the policy first and then lend it out. So then you're just making money in the policy, but then you lend it out and you're making money outside as well.
Right.
So it just adds velocity to your money. The more jobs you can give each dollar, the more they can grow. So just adds another job and gives it more velocity, tax-free.
We got who's your tax attorney?
His name is Suleiman. I can't even pronounce his last name. Hunamani or something like.
Right.
And basically, guys, like, if anyone wants to like get that structure that I talked about, I mean, all the wealthiest families and individuals have it. You talk about Bill Gates, Warren Buffett, Mark Zuckerberg. They all have private family foundations. That's why they pay little to no taxes on all these billions of dollars they make. They use this same kind of structure. So if you guys want to like learn about that and do it yourself, I will tell you, it's not cheap to set up. It's a $95,000 structure to set up. However, if your tax bill is going to be $400,000 like mine was, what would you rather pay, 400 or 95?
Right.
So I didn't spend 95, I saved 305. So most people, they don't have a tax problem, they have an income problem. They got to go make more money. And once you get to a point where you're making so much money, you only have so many write-offs. If you do all your write-offs and your tax bill is still over 100,000, that's when this structure makes sense.
Yeah. One more question. Can you use the whole life insurance policy for people with medical conditions, or is it going to be an instant no?
Great question. You can use it regardless. However, it might not be on your life. So if you don't get approved because you've got a terminal illness or whatever it is, you can still get a policy and use it just like what I've explained. You just have to get the policy on somebody else. Prime example, I own 3 policies that are in my daughter's name. She's the insured person. So God forbid she passes away, I get a tax-free death benefit. But I put the money in, I control the money. She's just the insured person. So if in fact you don't get approved, you can just insure a child, a spouse, a business partner, anyone you have an insurable interest in, which means someone you want to live for a very long time. You can't just insure Joe Schmo off the streets.
Right. Makes sense.
Cool. Well, once again,
I love it.
appreciate you jumping on. Hopefully we would love to do this like in person so I could get some content out of it.
For sure. We'll have to schedule another one when we can do that. But I appreciate you guys having me on. I appreciate
Absolutely
you jumped on. So
no, thanks for the knowledge. It's cool. It's cool having a different perspective of another way to make money. It's super cool. So love it.
No doubt. Well, if either of you guys have any questions, you know where to get a hold of me.
Damn
Appreciate
right.
it.
I'll be reaching out.
All right, guys.
Thanks, man.